Hi, this is Paul Sankey with an experiment for a new product, which is going to be the Monday morning call. Good morning call is held at 7 a.m. on Wall Street, so I'm sorry I'm late, but believe me, I've been screwing around with Zoom trying to work out how to do this. I've done it. Once we get past the Oscar controversy, which is not relevant to world markets, the big story today, obviously, is the Shanghai shutdown and COVID in China, which is a big deal. Obviously, anything in China is a big deal for all markets, but also in a very big year for China because we've got this October Party Congress coming up, and I'm somewhat debating she has to be re-elected. So we could get, in a drama-ish year. There's been drama every year, but this could be another drama this year. It would be change in China. The other thing to keep in mind is that they've set a high target for GDP growth, 5.5%, which many people think is unachievable, certainly with the COVID shutdown. But it does beg the question of exactly what's, as always, of what's going on in China. Will they be able to crank the economy in time for the October Congress? So that's item one. Item two was that we thought, having said all that bearish stuff about China in the short term, that this would be a short-term bullish week for oil because we're going into expiry on the distillate contract, distillate being the leader of the market here in oil. That's where the tightness is. That's where Russia's caused the most problems ultimately. And that's where we have the demand strength and the importance to the global economy globally. With Russia struggling in the way that it is, we're very interested in, and inventories being so low, we're very interested in what's going to happen on expiry of the NYMEX contract for distillate on Friday, which rather elegantly coincides with the OPEC meeting, which we expect to disappoint, is the phrase, but essentially they're going to continue doing what they're doing. Just keep in mind that OPEC meetings have to be consensus, unanimous decisions, and that would require Russia. And obviously the expectation has to be that they continue with the already agreed step increase, which they're not really meeting anyway. But the outside question would be, does Saudi and UAE crank up volumes in order to try and bring the oil price down? We don't think they're going to do that, and we think we're going to have to ride this Russia situation pretty hard, unfortunately. So we'll see what happens. I'm going to switch slightly here and try and show you a couple of highlight charts from the Sunday Sankey, which is going to take my glasses. I've got the share screen going. I've just hit the wrong button, and here is actually the Sunday. Here is actually the Sunday Sankey, and I just want to show you this. I'm very proud of this chart, which was made for me by a friend who goes under the name Crude Chronicles and does this incredible long-term work. The reason I love this chart is that most of the data series, particularly on Bloomberg, don't go back before really 2001. You'll see in the next chart. I've gone back as far as I can. It's only to 2001, and what it misses. And this is not quite the same thing, but the fact of the matter is, back here, oil was 32% of the S&P 500, believe it or not. Now, this chart is a performance relative. It's not quite the same thing, but back here, when oil had its first crisis in 73 and second in 79, this was oil at 32% of the S&P. Now, if you look here, in 04, I made the argument coming to Wall Street that when oil is rising in GDP, which is simply demand rising times price rising, oil rises in the S&P 500. And obviously we have that here, that demand is still strong with huge prices. You have that indicated to be overweight, the oils versus the market. Is kind of a no-brainer. It's only when demand starts to go negative that we'll have to start worrying. And particularly obviously in COVID, for example, when you get demand negative and price negative, you're going to majorly underperform the market, go figure. And you can see that in this chart, which is right here, but it's actually more interesting in many ways that the US unconventional boom, which started here in 2010, saw just this incredible underperformance of the oils, which was related to poor returns and excess spending. And now we have, random Democrats walking in and saying, hey, start spending. And it's like, dude, do you see what happens when we spend? So essentially what this shows you, in case you haven't picked it up, is the S&P market cap. Now, this is the correct way to calculate it. The market cap is this brownish line. The green is the oil's market cap, which obviously is pretty muted for the whole period, but changes radically in terms of its share of the S&P, because that shows you on this chart, oil share of the S&P 500. On this line, oil share of the S&P 500. Now, our target was 5% back here. We're going to hit 5. I've gone to 10. I'm not messing around. The long-term average is 9. It's like, obviously, this is going to come down. Now, an important part of that is the second chart, which is, again, showing you market, this is market cap. And what this is the Russell Growth Index, which has been the driver of the S&P, coming off here. And then this is oil's share This is oil in Russell growth, which has got, as low as almost nothing down here and is now rising. And you can see here oil's outperformance. This is the one index over the other. You can see that we're massively outperforming in growth. Now, this is very significant because when we were down here, growth was ripping and nobody cared about oils. The fact is that we're now rotating some significant names into the oil, and they're highlighted here, into the oil part of the Russell growth. And that is bullish, therefore, for these names, because our key argument is that having been driven by tech, the market's now going to be driven by oil, and particularly oil in the growth index. I hope that makes some sense. Highlight name is Oxy, but that's been ripping really on the Buffett move to take almost 20% of the company. Pioneer, Continental, Cheniere, Hess, Coterra, TPL, New Fortress, Fluence, blah, blah, blah. Halliburton is important because it's the only service company. And Devon is important because it's not in growth. So we think that's very significant. Okay, I'll leave it there and try to stop the recording, which I think I'll do right here. Have a great week. Good luck. Paul Sankey, Sankey Research, Crude Gusher on Twitter. Paul@sankeyresearch.com if you want to hit me.